Hi, this is James Shug with Westpac's Global Economics Wrap, prepared on Thursday, the 30th of April. Well, it's been a pretty complicated week on foreign exchange markets. One overriding theme, though, has been US dollar weakness. That's been driven by weaker economic data pretty much across the board, culminating in the first quarter GDP advance estimate, which came in at just 0.2% annualised. That was down from 2.2% annualised growth in the fourth quarter, and effectively indicates that at the start of the year, the US economy was pretty much stalled. It showed, the figures showed consumer spending growth slowing, business investment in structures falling sharply, related to investment in the oil sector falling away sharply because of the lower oil price. Equipment investment stalled. The housing investment grew, but only modestly. Net exports were a significant drag on growth, with exports themselves down quite sharply because of the stronger US dollar. And inventories added a little bit to growth, but we expect that will probably reverse in the next quarter. Government spending was a drag on the economy as well. So broad-based weakness in economic growth numbers for the US, following a run of softer data on the labour market, retail sales, and so on, has meant that expectations regarding the tightening of US monetary policy by the Federal Reserve, the eventual tightening, have pushed back from June this year, just a month or two ago, to some point in 2016. We had the Federal Reserve's meeting and statement yesterday, and the Fed kept its options open in regards to the likely timing of the first rate rise, but the expectation that the soft patch in the economic data that we've seen through the first quarter, the expectation that would soon be reversed is very much at the forefront of Fed policymakers' thinking, and if they're wrong on that, then Westpac's view that the tightening will come in September will probably prove to be premature, and the market view that it's going to come more towards the end of this year or in the early part of next year may well prove to be correct. So we've got to watch the US data flow. So related to that, the US dollar was weaker over the past few weeks, and that's meant that currencies like the Australian dollar have tended to appreciate. The Aussie rose from around 76 cents to as high as 80 cents in the last few days, with the stronger currency actually feeding into expectations that there'll be an increased prospect of a rate cut from the Reserve Bank next week. Westpac's view is that the RBA will cut rates, and in fact there was quite a bit of press today suggesting that a rate cut was likely, and that's actually seen the Aussie dollar weaken again from above 80 cents to 78 cents and change. The New Zealand dollar has weakened quite sharply against the Australian dollar over the last few days, because the Reserve Bank of New Zealand has instituted a mild conditional easing bias into its policy stance. So from parity just a few days ago, almost parity at least, the Aussie dollar has risen to 1.04 and higher against the New Zealand dollar, although it's since come back just a little bit because of this increased prospect of an Australian rate cut in the next few days. It's around 103 and change at the moment. The euro has been another big mover, from around 105 against the US dollar in the middle of April. It's now trading closer to 112. So the easing, or the depreciation in the euro that we've seen since the quantitative easing program was kicked off by the ECB in early March, the depreciation in the euro since then has been entirely reversed. And that'll be of some disappointment to ECB policymakers. There's still been a significant decline in the euro since QE was sort of first mooted last year. The euro declined from 140 at its peak against the US dollar in the middle of 2014. But the fact that it's not continued to decline since the policy began in March will be of some disappointment. In fact, equity markets have been quite a bit weaker in Europe because of the concerns that the stronger currency will impact on competitiveness. The other currency to watch will be sterling. We've got an election coming up next week on Thursday, and opinion polls make it pretty clear that it's not clear who's going to be running the show after next Thursday. No party has a clear majority, and there'll be a lot of horse trading, we suspect, going on between the major parties and the minor parties to see who will govern. And that's going to potentially provide a source of uncertainty for sterling, so watch out for some volatility on that front. The Japanese left policy unchanged at the latest policy meeting there. There was some expectation they might embark on further quantitative easing, but that wasn't to be the case. That's probably about it. We've got the monthly payrolls report coming up in the US at the end of next week, and that's the next big economic data piece to watch for, as well as the RBA meeting, of course, next week, to provide a bit of domestic focus, and we're looking for a cut there, as I mentioned. Okay, I'll be back with more same time next week.